Hi, I'm Steve Van Meter. Welcome to your weekly macro roundup. We talk macro and try to make sense of markets that, of course, only make sense on days the bond prices are up. I'm your host, Steve Van Meter, and thanks for joining me today because in this appropriately titled episode, The Boy Who Cried Inflation, you're going to learn what is going on in the markets today, why were tech stocks and everything else rallying, where is the money going, what's going on in the credit markets, very important to know. Is the Fed really driving long rates down, or is that just a ploy? We're going to tiptoe through the economic data to find out if we can find any of that mysterious inflation, and then what is going on with the Fed's corporate bond purchase program. Now, stocks were rallying, of course, because there's all this excitement that Congress is going to pass a stimulus bill this weekend, or maybe on Monday or Tuesday, or probably at some point in the very, very near future. And as always, you see this reaction and stock prices like, aha, finally we're going to see inflation, and everyone starts to run out and chant, inflation's coming, inflation's coming. It reminds me of the boy who cried wolf, except now he's crying for inflation. Inflation's coming, and yet all we get is a declining year-over-year rate of inflation. It keeps getting smaller and smaller, yet, but this time it's coming. People really think that we're going to blast right through the Fed's 2% target. They think that we're going to get, 5, 6, 7, 8% year-over-year rate on inflation. No, we're not. But the market jumped in and said, let's rally on this news because inflation's coming because, it just didn't happen before, right? And that's really what you have to look at. Did we get inflation on the last stimulus package? No. Not at all. The year-over-year rate of change is below where it was when it started. But isn't that always the answer? Well, Steve, the problem is you don't get it. It's never enough. If the first stimulus package were just bigger, we would have gotten inflation, right? That's the same problem the Fed always has. Well, if we would have just done more QE, we would have gotten inflation. It's always the same answer. Congress is going to do something inflationary. The Fed's going to do something inflationary. And yet, the sayer of truth, right? We all know what it is. What is it? And that's why, my friends, I wear the crown of the bond king, because the bond market, right? Treasury yields are the sayer of truth. And why do we talk so much about the bond market on this show? And it's not because my wife made this really cool crown for me. It's because the bond market tells you what's going on in the whole global economy. You can just look at the U.S. Treasury bond market every day and you have an idea of what the truth is. And what did the bond market say today about a potential stimulus package being inflationary? Yeah, it moved exactly zero. It moved up and down all day and closed zero, unchanged for the day. So the bond market doesn't see any inflation because stimulus has to be borrowed. We have to borrow the money, and the more debt the government takes on, that means interest rates go down. You can chart, take the total amount of U.S. government debt, invert it against Treasury yields, and you will see. Because people don't get what inflation is, and we've talked about it a lot on this show. It's the year-over-year change in consumer prices. The value of your house is not a consumer price. Tuition for your kids, not a consumer price. A bar of gold, not a consumer price. It's the year-over-year change in consumer prices. And when we look at the economic data, as we're about to, you're going to see that there's a whole lot more than just magically inflation going up. And we've talked about this, and we've looked at the data, but let's go back to the data here. It's a Thursday, and we see initial jobless claims rose 870,000, missed expectations. We're still running, near 1 million new jobless claims per week. That is very, very high. And when you factor all the people on some form of pandemic unemployment assistance, you have 26 million Americans. 26 million Americans receiving unemployment benefits. And yet somehow people think that's inflationary. Somehow unemployed Americans mean consumer prices are going to rise. Not sure I get it. Now, new home sales continue to rise. There is a shortage, obviously, in the housing market as people are fleeing the big cities, thinking they're never going to come back. They probably will at some point. The Kansas City Fed, we saw a an improvement in economic activity in their manufacturing index, although at a slower rate. And their composite index, which includes services, also expanded over last month, but at a slower rate in September. Let's move into today's data, where we get the core or durable goods new orders. They rose 0.4%, missed expectations. Now, let's go look at this chart, because this is the chart that Chris Dark and I worked on together. He did most of the work, and we shouldn't call it the Dark Van Meter chart, because that just doesn't work for anybody. So it's the Chris Dark new orders chart. And what this does is it looks at the total new orders of durable goods. If you're not sure what a durable good is, think something that lasts a long time: a washer and dryer, refrigerator, TV. And it excludes defense spending and new orders for non-defense aircraft and parts, because obviously not many of us are out buying new airplanes all the time. And what do we see here in this chart? Well, it decelerated a little bit to 0.75% on a year-over-year basis. So new orders from last August to this August improved by 0.75%. That's not much. In fact, when you overlay the consumer price index, what you find out is there is a relationship here. It's not super tight, but what you'll notice is when there is an increase in demand in new orders, consumer prices rise. Now, why would that be? Here, let me help you by making that a little bit bigger. I apologize. Why would that matter? Because in order for consumer prices to rise, there's a number of things that need to happen. First, you need to exhaust your current inventory. And it's been really difficult to find out where the real inventory levels are at, but you need to exhaust your current inventory level. Then you need to have consumers coming in and demanding a massive amount of goods. And then at that step, you need to tap out the current demand of the factories. So they already, many factories are, in the United States, around the world, have people working there. You need to tap out the existing demand or potential for the factory, and then you need to tap out the overall potential of the factory. So let's say that all these 26 million people come back to work because there's a sudden surge in demand for fridges and all kinds of things like that. That people come flooding back to work, and now you've exhausted the potential output of the factory. I mean, you've got 3 shifts running, overtime, and you still can't keep up with demand. That's where you get this surge in consumer prices, because at that point, my friends, is where you see prices rise. So coming back to this chart of new orders, why does this matter? Because consumers, their demand for durable goods tells you where inflation can go. And you can go back to the post-great financial crisis, and you can see durable goods new orders that were over 24% on a year-over-year basis. And the CPI was sitting at a little over 1%. But this time people think, oh no, this time the CPI is going to just shoot way off the charts. Probably not going to happen, because there isn't that kind of demand out in the economy. And that is one of the problems. People have trouble with understanding inflation. It is a rise in consumer prices, and you need demand from consumers for goods and services to do that. All right, let's go check out what's going on in the banking sector, because credit tells you, if you're seeing people borrowing to buy stuff, that will give you a indication of what is to come. Now, what do we find out today? Securities and bank credit dropped about $10 billion. For some reason, the commercial banks have been unloading their mortgage-backed securities, so I don't know where they're exactly going. I know they're all not going to the Fed. The Fed's buying about $40 million a month. So maybe there's some other buyers out in the market looking to grab mortgage-backed securities. I don't know. We don't get the data on where these are going. And then there was a small increase in Treasury securities. So there was a net decline by $10 billion. But we'll notice Treasuries really didn't budge that much last week. How about loans and leases at all commercial banks down $15 billion for the week? With commercial industrial loans making about minus $26 billion impact on that. Real estate loans up $6 billion. So still, despite all of this demand for mortgages and new homes, we're not seeing a massive surge in real estate loans. How about commercial real estate loans which I'm baffled why anyone would loan money out to this area, up $1 billion. And now let's look at the consumer, down $1 billion. Consumers paid off $1 billion of their credit card loans. Automobile loans remain flat. Other consumer loans fairly flat. So there's not a lot of demand from the consumer space. How are you going to get inflation? Well, the answer is you're not. And that's really important to understand. Let's switch over to the PowerPoints, look at the money supply. We see the year-over-year rate of change jump to 24.7%. The 6-month rate of change is falling, although I suspect that will change in the near future. And the 3-month rate of change is continuing to rise at about 2.5%. But where is all of this going? What is going on? Well, what's interesting, now some of you will know, what comes after September 14th? Yes, I know it's the 15th. I know that. But what is so special about every September 15th? And some of you are groaning. You go, oh, yeah, estimated tax day. That is right. And what do we notice? We notice money coming out of savings accounts. So preceding period decline, and money was going into checking accounts. Well, when most people pay their estimated taxes on the day they're due, not before, on that day. So I'll be interested to see if next week there's any decline here. We also saw institutional money funds draw down as obviously money is flowing back into the stock market. Let's continue on to the monetary base unchanged. We should get an update next week. We go 2 weeks without, they don't update it, but every 2 weeks. So that no change there. The money multiplier, because the M2 hardly rose at all, the money multiplier is flat. Again, no sign of inflation in the money multiplier at all. Falling money multiplier suggests disinflation. How about real estate loan growth? Now this did tick up slightly, ever so slightly, to 3.1% from a year ago. This is a very low rate of long-term trend growth, especially with rates at all-time low. The 6-month rate of change is down to 0.18%, and the 3-month rate of change rose massively off of the 0 to 0.14%. So don't get too excited about it. It's still telling you there's no real growth in the real estate credit market. And if there's no growth, how do you get higher interest rates? Well, you don't. Commercial industrial lending growth rate on a year-over-year basis down to 16%. The 6-month rate of change is down to 1.24. This is on its way to being negative. The 3-month rate of change actually improved, but is still holding around minus 5%. And that means all loans and leases at all commercial banks, the growth rate is down to a very unhealthy 5.75% from a year ago. The 6-month rate of change is now turned negative, telling you where the year-over-year rate is headed. And the 3-month rate of change has continued to be negative, but it's improved slightly. But how about those consumers that need to go out and spend to drive consumer prices higher so we can all get validated that inflation's coming? Well, you didn't see it on the credit card growth rates, now down to minus 9.4% from this time last year. There is no sign of inflation in the credit data at all. And yet, so many people believe, well, the stimulus package will do it. The election will change it. This will change. I mean, it's always the same story, right? Inflation's coming, but it never comes. More is better, It never happens, right? I mean, it's the same story every time. Now, what's going on with this corporate bond purchase program at the Fed? I want to show you that because everyone said this was inflationary. Do you remember that? Oh, the Fed's buying corporate bonds. Oh, that's got to be inflationary because when the Fed buys corporate bonds, companies are going to issue bonds to buy their stock back. You know what's amazing to me is how many people forgot we had a pandemic and corporations were almost out of business and needed to borrow money to stay in business, yet the automatic assumption was, oh, the Fed's buying, so they're going to issue debt to buy their stock back. Okay. Well, here's what's interesting. In this data, the Fed was originally buying about $300 million a day of corporate bonds. They're now down to about 9 million. It's not 9 billion, 9 million a day. And remember, this was the reason people said, oh, you got to buy stocks. Inflation's coming. And you don't hear any of them talking about, well, we're only at 9 million. Is that going to lead to weakness in the equity market? Well, I'm really not sure. I have to check in with their view. So is the Fed going to bring long rates down? Now I got to switch over. You're going to see my OBS screen here for a moment. And there you go. So I've been tracking, and this question came up on Twitter. I've been tracking the purchases by primary dealers from the auction. So I track them here. I copy and paste all the data in to get the percentages, and I put it here against what the Fed is buying. So in column C, this is what the Fed is buying. I don't break it down granularly and go through each one to figure out exactly where it fits. I just look at the broad purchase of where it's at, and we track what's the actual. Now, here's what's interesting. This month, the Fed was short the primary dealers were short 1.7 billion of what the Fed needed. So that means some of this money had to go out, or some of the primary dealers had to go out to the open market and get it. Not entirely true. If you look at the tips, right? Treasury inflation protected securities, the Fed's buying, 7.3 billion? And the primary dealers are only taking in less than 2 billion a month. That's more than 2 billion, isn't it? But anyways, it's 2 billion. Nevertheless, I'm blinded by my own screen here. Nevertheless, some people believe this is why we're seeing some potential inflation, because the Fed's over-purchasing tips. But notice on the 30-year bond, the Fed's buying 10.5 billion. Now, mind you, Monday is our last purchase for this cycle, and we should get a new schedule for QE. And they're only primary dealers are only buying less than 5 billion, or say 5 billion at the auction, meaning they've got to go out in the market and source 5.5 billion of 30 years. And yet people say, oh no, the 30 years yields are going up. Well, it's really hard when there's $5.5 billion shortfall per month. I mean, this has been consistent. So where is the Fed struggling in their purchase program? Somewhere between the 7 and 10 year. They pretty much got the 2 year nailed. And some of these 3 years flow into the 2 year. They've got that covered. It's somewhere around that, I say on average. The 7 year is where there's a little shortfall. And if we could see what the primary dealers are buying or holding in their inventory, we'd probably see a little bit of a glut here. But on the long end of the curve, the Fed is absolutely keeping rates down. And that's why when we go and look at the charts real quick, now remember on Sunday I've updated format for you. We're still going to continue that. Hopefully I've got some of your feedback will improve upon this. Here's 30-year Treasury yields. Everyone says inflation's coming, and yet here you go. Here's your stimulus. Where's the inflation, right? It's like that old Wendy's commercial. Where's the beef, right? Where's the inflation? The boy who cried inflation is not here. And we're seeing the 30-year Treasury yield just seeing right over its 100-day moving average here in blue. If it gets below these moving averages, that is a pretty big deal. And why is that? Because there's a lot of momentum-driven computerized trading programs out there that run strategies for large insurance companies, institutional money managers, and they look at changes over the moving average. Now, it doesn't mean that the day it moves over, the next day they go full bore buying, but they're looking for a cross of the moving averages and then a move higher. So here we have the inverse of Treasury yields, TLT, and this is a long-term Treasury bond fund. We see it close for the second day over its 100-day moving average, and its major level of resistance where sellers have been dominating just a little higher. It gets through that. It's got an open gap here to fill a run up to 172 and a breakthrough. You look at knock on the door, failed, knock on the door, failed, third time, it'll get through. Knock on the door, failed, knock on the door, failed, third time. It probably, and I expect it to get through. So the Fed is actually supporting the long bond here. The credit markets are supporting the long bond. And with that, my friends, be sure to subscribe. I know many of you have. Be sure to like. And if you missed my interview with Brent Johnson, check it out. It's on the Real Vision channel. Check that out. I know many of you have enjoyed it. And I will see you on Monday. We'll check out the Fed's new schedule, see what's going on in the markets. And remember, as we close out this quarter and month, there's an estimated 200 billion of equities that need to be sold into bonds. Now, I don't know how much of that's already happened so far, but the next 3 days in the month should be very interesting. I'm Steve Van Meter. Thanks for watching, and I will see you on Sunday for our big chart pack update and see what's going on with our new format, and I hope you enjoy it. See you then. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell a security, financial instrument, or participate in a particular trading strategy. This video was prepared by Steve Van Meter. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.